If you pay for childcare or care for an adult dependent so you can work or look for work, this update matters. The Federal Child and Dependent Care Credit, CDCC, allows you to claim up to $3,000 of eligible care expenses for one qualifying individual, or up to $6,000 for two or more, helping reduce your tax bill. In this video we'll walk through who is eligible for the credit, how the $3,000 and $6,000 limits work for 2025 tax year, the mechanics of how the credit reduces your tax, and when you might see benefit. What to do now so you're prepared when you file. What is the Child and Dependent Care Credit? The CDCC is a federal tax credit you may claim if you paid for care of a qualifying individual so you and your spouse, if filing jointly, could work or actively look for work. Key facets: it's not a direct stimulus check, but a tax benefit. It reduces your tax liability, the amount of tax you owe. If you owe no tax, the credit's usefulness may be limited. You claim it when you file your tax return, Form 1040 plus Form 2441. Bullet points: care must be for a qualifying child under 13 or a dependent spouse unable to care for self. The care must allow you and spouse to work or look for work. You must file taxes for that year and attach proper forms. The $3,000 and $6,000 limits explained. One of the most important numbers you'll hear is the $3,000 and $6,000 thresholds. Here's what they mean. For tax year 2024, filed in 2025, you may use up to $3,000 of eligible care expenses for one qualifying individual. If you have two or more qualifying individuals, the limit increases to $6,000 in eligible expenses. IRS. The credit amount you receive is a percentage of those eligible expenses, and the percentage depends on your income, adjusted gross income. Bullet points: eligible expenses means the cost of care you paid for work-related reason, less any employer-provided dependent care benefits. IRS. If you paid only $2,000 for one child, then you're limited by $2,000 used in calculation, not full $3,000. Two children, you can use up to $6,000 in expenses for calculation purposes. How is the credit calculated? Understanding how much your credit can be is critical. Take the smaller of your earned income, or your spouse's, if filing jointly, and the eligible care expenses, up to $3,000 or $6,000. Then apply the applicable percentage, which depends on your adjusted gross income, AGI. The lower your income, the higher the percentage, up to about 35%. Bullet points: example, you earned $30,000, paid $3,000 in eligible care for one child. Assume 20% credit equals $600. If you paid $6,000 for two children and meet income criteria, up to $6,000 times applicable rate. Credit is non-refundable. In most situations, if you owe no tax, the benefit may be reduced or unused. Who qualifies and who does not? Let's look at the eligibility rules and common disqualifiers. Qualifies if you paid care expenses for a qualifying individual, child under 13, spouse or dependent who cannot care for self and lived with you more than half year. IRS. You and spouse, if filing jointly, have earned income. IRS. If married, you file jointly, in most cases, unless special rule applies. Does not qualify if you are married filing separately, in most cases. IRS. The care was not for the purpose of enabling you, or spouse, to work. Care provider is your spouse, parent of child under age 13, or your dependent. IRS. Bullet points: make sure the care was for work-related reason, not simply convenience. Documentation matters. You'll need provider's name, address, TIN or SSN. If you or your spouse are full-time students or incapacitated, special earned income rules may apply. When and how you get the credit. Important to understand, this is a tax credit, not a prepaid check. You claim it when you file your federal tax return for that tax year, e.g. tax year 2024, filed in 2025. Once you've filed, any refund or reduced tax liability will reflect the credit. If you are due a refund and you chose direct deposit, you may receive it with your tax refund once processed. Bullet points. There is no separate payment schedule from IRS solely for CDCC. It depends on your tax filing and refund process. File early if you expect refund. Keep documentation of care expenses and provider information in case of IRS review. What's changing for 2026 and beyond? While the message often focuses on $3,000 limits, the landscape is evolving. According to recent analyses, some proposals suggest the credit will be expanded for tax year 2026, increasing the percentage and possibly improving refundability. However, for tax year 2024, filed in 2025, the $3,000-$6,000 ceilings still apply as per current rules. Bullet points. Stay updated on legislation. Congress may change limits or refundability. If your tax year is 2025, filed 2026, watch for new rules early. The credit remains non-refundable in many cases. Changes may alter that. What you should do now to prepare. Here are proactive steps if you'll file and hope to claim the credit. Keep a detailed record of your care expenses, receipts, invoices, provider details. Ensure the care provider is not your disqualified relative. File your income taxes on time and claim the credit via Form 2441. Confirm that your provider's name, address and TIN/SSN are accurate to avoid rejected claims. IRS. Bullet points. Gather all care expense records for the tax year. Validate that you earned income, and your spouse if filing jointly. If you file electronically and choose direct deposit, you may receive any refund sooner. Avoid last-minute rush. Errors may delay refund. Common mistakes and how to avoid them. Many filers miss part of the benefit due to avoidable errors. Mistakes include claiming care when not needed for work. Care provider is invalid, relative, underage disqualification. Failing to include provider info or care expenses exceed limits. Filing married separately when married. Bullet points. Double-check that care was for the purpose of you working or seeking work. Confirm that provider's SSN/TIN is correct. Make sure expenses do not go above the $3,000-$6,000 ceilings for eligible claim. Use tax software or consult tax professional if unsure. Why you might not see the credit immediately. If you expect to benefit but don't see a change, here are possible reasons. Your tax liability may be lower than the credit. Non-refundable portion may limit benefit. Your return may still be processing, especially if large credit or high refund. Incompatible filing status. Married filing separately. Your documented expenses did not meet all eligibility criteria. Bullet points. Check your tax return summary. The credit should appear on Form 1040. Use the IRS refund check tool if you expect a refund. If selected for review, your refund may be delayed. Keep records. Here's the bottom line. The Child and Dependent Care Credit allows you to claim up to $3,000 of eligible care expenses, one qualifying individual, or $6,000 for two or more. It reduces your tax liability, not necessarily a check sent separately. To get it, you must file your tax return, meet eligibility, and have your documentation in order. If this video helped you understand the credit, please like, share, and subscribe so you don't miss other important tax benefit videos. Thanks for watching. Stay informed and get the tax relief you deserve.